It's happened. Battle between Russia and Ukraine has begun, and I'm deeply saddened for the people living in Ukraine who have had to move out because of the attacks on their homes. From me, growing up in school, I learned about all the conflicts that had happened in human history, and I never thought they were possible to happen in my time era, because let alone a pandemic, I didn't think a conflict like this would happen, because I thought we were past this type of stuff. However, people like me and some of the yous out there, at least it hasn't affected our safety, and I stand behind the people of Ukraine, and hopefully you guys can gather some happiness and enjoyment out of this video. Hey guys, Hayne again, and today we're going to be talking about what's going on around the globe as a Russian missile attack has demolished buildings inside Kharkiv, and over 350,000 people living within the city and around it have had to seek refuge in places like Poland. And this invasion has made me feel sorry for the countless innocent lives that have been affected right now because of this, and plenty will be lost on both sides of the outbreak, all in order just to solve politics and, petty things, really. It's absurd because the last time the Russians have fought their way into Kiev was over 80 years ago in order to liberate the capital from the Nazis. And it's crazy how once allies underneath the Soviet Union, but now they're enemies as Ukraine has moved towards NATO, or the North Atlantic Treaty Organization, in order to form allies and build a better economy with most of the West. No, not that West. Alright, let's be a bit more lighthearted. And although the Russian people don't want this stuff to happen, they're forced into this by the government and must comply with these circumstances. And the people are really struggling underneath these sanctions. Sanctions affect the Russian people economically by removing their foreign currency support, which was established by my own country, Australia, among others, as well as cutting the central bank support through Europe's central banking system, which will pressure all the lives of the Russian people as their currency becomes worth drastically less, which in the grand scheme of things is the world's telling the Russian people or incentivizing them to abolish their leaders in power. Furthermore, we'll see higher inflation because the US will have to support all these surrounding countries, which in turn causes mass expenditures already in the times that we're in. We're still really unsure though about what the Fed are doing about these interest rates, which is my first worry for all the people like myself who invest in tech stocks. Fear has been everywhere in the stock market recently, and this has especially affected tech stocks, as they are much more volatile than all your blue chip stocks, especially ones who are paying dividends. And with the opposing question around interest rates, these businesses that love to gather cheap debt in order to reinvest into their expansion will not be able to acquire debt with such low interest rates, making it much more difficult for these growth companies who are trying to hit their goals profitability-wise. So investors at the moment are really uncertain about what these growth companies are doing in order to achieve their business model and reach exponential growth along their S-curve. The idea of the S-curve is really simple, as it demonstrates how smaller companies in their infancy are able to grow rapidly over a number of years in order to mature and settle their company to make steady revenues. The question really is though, is some of these fears already priced into these stocks, or can they fall just as low? But for all we know, the market could rally any day now and surprise us out of nowhere. So we as investors really don't know if a company like Amazon, which some of you have researched and think is undervalued, there's declines to 20% since November, or it can fall lower over the coming months. Either way, if you've researched it, you can dollar cost average it over the next couple months anyway, and still buy at a cheap price. Commodities are heavily affected in times like this, as oil and gold have risen immensely over the last month due to rising tensions. Now, history has shown that tragedy that has caused fear in the markets has led to rapid rises in gold prices, such as the period between 1977 and 1980, where the Iranian Revolution and Soviet Union's attack on Afghanistan caused gold to rise 360% in just this 3-year period, as well as economic uncertainty after the 2008 financial crisis, where it rose 144%. So we can expect gold to surge as conflict arises around the world. The other commodities hit me really hard is crude oil. Petrol prices have clipped $2 per litre here in Australia, and for those in America, if I convert that to gallons, it's just over $9 per gallon. And if I show the US national average of $3.73, Australia is about 40% as expensive as California, the most expensive state for petrol prices, where it's hovering at roughly $6.75 in Australian dollars. So for you guys over there, stop complaining. Okay, fine Europe, I get it. An interesting prospect for the next year is how cryptocurrencies, and especially Bitcoin, will fare in these circumstances. as in its 12 to 13 year lifetime, it has never seen a conflict or any real recession. Since the 2020 pandemic recession didn't affect markets for longer than a few months, before we saw all-time highs again. Although I believe that Bitcoin, after the run-up we had in November, is consolidating until the next halvening cycle. And the halvening cycle, for those who don't know, is when every 4 years Bitcoin becomes twice hard to mine, hence becoming a more scarce asset for us to hold. And really all the negative news around cryptocurrency is already priced in, amongst Gary Gensler increasing regulation in the asset class, which isn't necessarily negative news for the cryptocurrencies, as it can be quite productive for adoption. And of course the spot ETF that was rejected, the cent price is crashing down, but until more regulation comes in, it might come sooner than we think. So what can we conclude? Well, Warren Buffett has always said that to be fearful when others are greedy and to be greedy when others are fearful. And this is especially true during recessions, as you're more likely to actually make money than lose money. In the last 11 recessions since 1948, the stock market has returned 6 positive returns for the S&P 500, for an average return of 10.33%. On the other hand, for the 5 negative returns, it actually gave us an average of negative 12.2%, which sounds horrible, but if you take out that large anomaly, which was the 2008 global financial crisis, the S&P was only negative 4%, which is what my portfolio is experiencing every day at the moment. So for the average investor, let's continue to dollar cost average into the market as much as possible and forget about trying to time our investments. Now here's another point for the famous investor, Peter Lynch, who managed a Fidelity hedge fund between 1977 and 1990, whilst averaging a ridiculous 29.2% return annually. His book, One Up on Wall Street, is absolutely terrific and I highly recommend reading it, and not only a great investor but an exceptional teacher, gave insight into how investors should react during times of high inflation.
No one can predict the stock market. They try to predict the interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.
Well, there's some food for thought. We have large falls in the market constantly, but people get too caught up in the economics of it, instead of just investing into great companies at a discounted rate. Anyway guys, thanks for watching, and here is a link to my last video where I invested into 10 of my favorite companies to buy and hold. Smash the like button for this video. Let's try to get to 10 likes. Comment about your thoughts about the market right now, as well as your investment strategy during these times. Let's also show some support for the struggling Ukraine people, as this is a conflict no one wanted. And of course, don't forget to subscribe, and I'll link to my socials below. And once again, Hayden out.